It's Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. I'm recording this in the afternoon, a very hot afternoon, I should add, in London on Thursday, the 16th of July. We're all feeling a little deflated here in the UK after England's loss last night in the World Cup semi-final. But soldier on we must, and let's open the slides and have a somewhat abbreviated chat about this week's market events. I've called this week's podcast Budget Summer, as we're going to speak about later, there are some tough choices to be made when it comes to expenditure, and I'm not speaking about the flavour of ice cream. Here in the UK, we are looking at a new Prime Minister taking office on Monday. Andy Burnham will take the mantle, and there will be a whole slate of new appointments in government there. A lot of speculation around the Chancellor of the Exchequer, clearly an essential role when it comes to the purse strings of the nation. And there will be a lot of focus on the fiscal policy of this new government and how much can be done to shore up not only investment in the UK, but confidence in the UK. As usual, we will speak about inflation, interest rates, geopolitics, equity markets, and other asset classes. And some of the subtopics for this week are inflation taking a little bit of a surprising turn to the negative in the case of the month of June, of course, backward looking. And it will have been distorted again by the oil price rises in July, but enough of an indicator that maybe the Fed can think about relaxing its no rate drop policy. The chairman of the Fed, Kevin Warsh, is not taking a victory lap. We've seen his congressional testimony, his comments on the inflation situation, and we can look at where we go from here. When it comes to the budget idea that I've expressed earlier, we will look at how companies are making ends meet and where they are taking the expenditure from in order to cover their new expenditure on AI. We're going to look at another form of rotation, which has captured the headlines this week within equity markets, and this may in fact surprise you. Looking at inflation expectations, so the headline on the right, inflation expectations on the rise, says the Fed, that actually is a headline from last week. So just the way we are seeing these real completely polar opposite points of view on inflation is just how difficult it is to really read numbers at this point. If we look at this Bloomberg chart suggesting how the inflation cookie crumbled, we can see that although energy was still a large percentage of the price hike, it is falling, at least it was in June. This may now have changed again when it comes to July. Food has been fairly stable and core services remain also fairly stable. That is the one to watch. That's the bit that is somewhat difficult to erase from inflation in the last mile. If we look here at the inflation turning negative, it says big falls in oil allow very occasionally for sharp reversals in prices. As we know, there was a fairly instantaneous transmission effect of the oil price through to fuel prices. They did fall in measure and I suppose in the expectation of new ships going through the Strait of Hormuz. So there was a suggestion that the June inflation number was sufficiently soft that consumers could relax, and indeed that the Federal Reserve could relax around being super hyper focused on the inflation number. Now that we are getting a few weeks to compose a verdict on Kevin Warsh, the new chairman, we can see that there has already been a sharp fall in expected rates thanks to the low June CPI number. Expectations critical when it comes to interest rates as well as inflation, as we've noted before. And as we can see now that inflation predictions have been dipping below 2% for the first time in the second Trump term. So I should say that Kevin Warsh did hesitate before taking a victory lap, even though he may have been encouraged to do so in Congress. So clearly far too early to come up with a verdict around inflation and it being vanquished. And equally, they're quite difficult to predict the ultimate trajectory of rate rises here. I'd say it is interesting just to see how much the oil price, though, can really affect that top line inflation figure. Going back to the oil price, we've obviously had this on again, off again blockade around the Strait of Hormuz. And one critical number that is affecting the sensitivity of the oil price to the geopolitical developments is the fact that US oil inventories are at their lowest since 1984. This chart on the left shows just where those inventories are. Clearly, very little in reserve, very little in terms of slack, little in terms of the ability to release this into the system. And we've had that warning from oil traders suggesting that the market is running on close to empty as Hormuz shuts again. Clearly, misunderstandings have prevailed when it comes to the situation in Iran. We have seen skirmishes blow up into full-blown conflicts, and equally quite a lot of rhetoric on both sides. Clearly, things have been far from resolved there. And now that we look around the corner to the winter approaching, we can tell that this is going to be much more of a sensitive topic for economies that are dependent on oil here and that are looking to control their prices in order to preserve the consumers' well-being. If we look to the recession probability, however, we can see that thanks to the strong performance of companies, the ongoing resilience of employment, and the economic growth which is coming through, as well as the recent indicators of lower inflation, we are seeing fairly low probability of recession again in the forecasts. If we look at the probability over the next 12 months, according to a Wall Street Journal survey of economists, the probability is back to 25% now, having been as high as 75% in the aftermath of 2022. So it's quite interesting to see just how much that has come down, just how optimistic we can see that these economists are. And this has also been translated into a lot of optimism around corporate earnings, in particular around financials. Financials are, I'd say, a true barometer of how the economy is feeling about its financing possibilities going forward. There is a very strong link to the consumer when it comes to financials, and tying this together, the fact that financials have been doing so robustly in the aftermath of the current boom in equity markets and trading volumes is just a sign as to how much the economy generally is looking more positive, and how the probability of a recession has fallen to such a low level. Looking at the rotations in equity markets, I will say that we have had quite an interesting reversal into equity markets recently. If we look at the US small caps, we can see that they have been soaring as investors look beyond big tech. If we look in particular at the Russell 2000, it's having its best year in 23 years since 2003, helped by AI spending, tax changes, and of course the starting point of fairly low valuations. This is an interesting trend, this rotation into small caps, because it has been something that's been predicted for some time. The likes of Mark Cuban, we cited a few months ago, as saying that the next shoe to drop essentially in productivity would be the small and mid-cap sector, that were poised to unlock tremendous productivity gains thanks to their AI implementation in their companies. We do know that large companies have, for the most part, been the early adopters there. But the really interesting part here is that there has been somewhat indiscriminate demand for the Russell 2000. The chart on the left from the Financial Times, original source HSBC, is showing that the total return of companies with positive earnings has actually been surpassed by companies with negative earnings. So this is a suggestion of risk appetite as far as I can see. If we were to look at negative earnings, generally this will not be a persistent loss that a company is expected to make. It could be that J curve at the beginning of a company's investment, the fact that there is going to be some negative cash flow effect of having the investment that's been made on AI, as well as just that overall set of investments that are necessary at the build-out stage. If we look at this around the Russell 2000, it is fascinating to see that the risk appetite has now become so strong that there is even a rotation into the loss-making small cap companies, not just the larger companies. I mentioned earlier that financials were having a good run, and certainly with the exception of Citibank, we have seen a strong rally by bank stocks, and particularly Goldman Sachs was standing aside there. And there was, even though there have been at times fears of AI disrupting financial services, for the most part, the sense seems to be that AI is actually supporting much of the activity that will drive financial services. It's driving some expansion. It's driving the need to raise capital, which of course is good for financial services. It's also driving this the trading volume that we're seeing here as investors get more exposure to the AI theme. And to take that even further, of course, it goes beyond the equity markets, also into infrastructure, etc. So banking sector doing well. That again is a nice ballast for the equity market. It's not all focused on tech. But countermeasure, the IBM fall of 25% in one day, essentially to erase 25% of a market cap of a company the size of IBM in one day, was a staggering level of volatility. This seems to perhaps be overdone. in the sense that IBM is not the only company that is going to see some consumer hesitation regarding spending on its physical computing as opposed to some of the spending that would have been clearly on AI. I think what was even more interesting, though, is what they said. The IBM's woes means for the rest of the AI world. What they had suggested was that the consumer was spending now more on AI and at the expense of their hardware. So that essentially suggesting that the consumer's budget was limited. Actually, this is more the corporate level expenditure, that the expenditure is limited and that there essentially is a limited purse and there has to be a trade-off in effect when it comes to spending. If there is already this trade-off happening at the enterprise level, this trade-off is also going to happen at the consumer level. And whereas Apple in the past has seen sustained demand for its physical devices, we are likely to see consumers making trade-offs, even the high-end consumer that is traditionally the consumer that drives the most earnings. So definitely one to watch there. And when we look at SpaceX shares, which have been a barometer, we could say, for the hype around new issues, unproven and speculative business models, and even that hope factor, what we can see is that they have come back to earth fairly quickly. There has been a closing price there of just above the IPO price. So I'd say since the initial spike, we've seen a fairly sustained sucking of the air out of some of that bubble that we saw in SpaceX prices, again reflecting just some of that skepticism starting to creep in around SpaceX and the valuations of these AI, very AI-centric, AI-driven companies. I think it's interesting to look outside the US market to also get a sense of the risk appetite that we're seeing. In a previous podcast, we spoke about some of the buzzy new derivatives that were taking place and what we're seeing, and the concern around, for example, these derivatives that did not have expiry dates. And there was also reference in Korea when we used the term a Korea in the coal mine. It was a week where we had seen the Korean stock market falling by 10% in a day, and a suggestion that the single stock leverage ETFs, we're seeing were partly behind that there was not only this over concentration in the Korean stock market with the top tech stocks, particularly this concentration around 3 stocks, to name 2, Samsung and SK Hynix. We also had heard about some of the derivatives that were in place over these stocks and the suggestion that this was leading and really compounding the volatility and some of the risk sensitivity in there. If we look here at the single stock leverage ETFs, we can see that the assets there are growing and that we have, this is just an example of why would there be leverage essentially applied on top of an ETF and why would this be attractive. It is really comes down to a growth in risk appetite. Clearly, when we start to lever single stock exposure like this, we are building in more volatility, more riskiness. And the fact that this has been creeping up just at the time when there was a record listing of SK Hynix on the US stock exchanges, this is again a sign of just the globalization of much of these risk themes, as well as the precariousness of when extra layers of risk start to be added. So that is it for this week. In terms of geopolitics, clearly we continue to watch the political scene here in the UK with the new Prime Minister incoming, as well as the geopolitical skirmishes around the Strait of Hormuz. Clearly it will be very much feeding in to the oil price as well as to market sentiment. There continues to be a strong level of debate around AI, at the pace of adoption. An interesting commentary this week from the likes of Satya Nadella, suggesting that there has been this as with overlooking of the proprietary layer of alpha that could in effect be outsourced to multiple models, and that there has been perhaps a reckoning in terms of the willingness of big corporates to essentially turn over information into these models. So I say that AI topic is continuing to circulate. Inflation will be very much in focus, as will the oil price, as we look at the rest of the geopolitics unfolding. And in the political scene, we know we've had the death of Lindsey Graham this week, a kind of sudden affair, as well as a change in the main Senate candidate. And all of this creating more and more noise as we come into the midterms. So I'd say that is one to watch. The World Cup may be coming to an end, but certainly some of the frenzied focus on the US is not. So thank you very much, everyone, and look forward to seeing you next week.